Welcome back to How to Retire. I am Scott Newhouse, and in this episode, we are going to talk about how to pay less in your lifetime tax bill. Before we get into it, though, we have to start with our quote for this episode from Anonymous, our good friend, which is, people who complain about paying their income tax can be divided into two types, men and women. I work with so many different people, all different stripes. They all want to pay as little in taxes as possible. I do have to warn you, though, there's a chance that taxes might go up in the future. I've actually talked about this in the book that's behind me, The Retirement Tax Bomb. You can get it on Amazon. You can download it on my website for free. And there should be a course available for you to sign up for and kind of listen to the whole book, me talking and describing the whole book. That's on my website as well. But I copied this from the book, and I want to go into 5 reasons why I think we need to be worried about taxes going up in the future. So 5 reasons why taxes will go up. The first problem that we have is that we don't have enough workers, and especially workers per retiree who is receiving some kind of Social Security benefit. Now, in 1945, you can see that there was around 42 workers per one Social Security recipient. And I don't have the updated chart for 2020, but as of 2010, we had around 2.9 workers per Social Security recipient. So you can see the really precipitous fall down of people who are employed paying into payroll taxes to support our Social Security system. And I don't think this trend's reversing anytime soon. The second trend that we have to be worried about is we've got too many retirees. God bless you. But we've got around 10,000 people retiring every single day, up from around 5,000 per day back in 2000. And census projections think that that's going to rise to around 12,000 retirees retiring every day. We've got the proverbial baby boomers, entering retirement. Some have already been in retirement for a while, and they're going to be claiming their benefit that they've earned of Social Security. And we've got to combine that with the lack of workers that we have, and not enough people paying into our payroll tax system, unfortunately. The third problem that we have in terms of our tax situation is that there has been a steady increase in mandatory spending via Social Security, Medicare, and Medicaid. And you can see, if you're watching on the video, back in 1968, mandatory spending, i.e. automatic spending that our politicians in DC do not have control over, they just have to fork it out. Mandatory spending made up 28%. But in 2018, 1968 all the way up to 2018, mandatory spending made up 61% of the federal budget. And then in 2028, that number is projected to increase all the way up to 64%. And so the main problem that I see here is that the mandatory spending, the percentage of the, expenditures that the government's allowed, it continues to go up, which means discretionary spending, i.e. the fun money for our politicians that they can spend on their pet projects, is going down and down and down. Now, I've got to ask you, do you think our politicians in DC are going to be happy about that? Or do you think they're going to want some more money to play with so that they can fund special projects and different things that, I got to give them some credit. Maybe they think, we need to spend this money and it's in the best interest of the country. Up to you to decide, if you think they're spending money in the right way. But I just think that our politicians are going to want to spend more money. And if we have a higher and higher percentage going to mandatory expenses, then that's going to be less money that they can spend on their own. And they might say, hey, we need some more money. Where are they going to get that from? Our fourth problem that we have is we have a trust fund depletion. So back in the late 80s and 90s, early 2000s, we accumulated money via payroll tax. And with that surplus that we had, we put it in a trust fund. And really since the early 2000s, we've been spending down what we've had in our trust funds for Social Security and Medicare. And so you can see on this chart right here, our trust fund was up really significantly. We've been spending it down over the last couple decades, and our trust fund is estimated to be depleted in 2033. That's for Social Security. They run these numbers, honestly, every 6 months. So you might see a new study that's come out since you see this video, and it might be 2032 or 2031 or 2034. The point is, at some point in the early 2030s, our trust fund for Social Security is expected to be depleted. And a problem that we have with that is that right now, our Social Security benefits are paid out via payroll taxes as well as the trust fund. So if the trust fund runs out, we're only going to have payroll taxes to fund Social Security, and that's not enough money to pay out the 100% of stated benefits that you, our retirees, have earned and put into the system. And so there's going to be a deficit, and then what's the government going to do there? Are they going to cut benefits, or are they going to raise taxes to make up that deficit that we have? Medicare, it's the same deal, except their trust fund is expected to be depleted in 2026. And so it's really the same type of thing. We've been spending down our trust fund over multiple decades. Our politicians have not made any changes to the system to kind of address that. And now it's kind of time for us to pay up and figure out what we're going to do next. The fifth reason why I think taxes might go up in the future is that we have rapidly increasing debt, deficit, and interest. Right now in 2023, our national debt stands at $31.5 trillion. And obviously, since 2020 and COVID happened, we've had an exponential increase in our national debt. Our deficits over the last 20 years, we've had deficits pretty much every single year. Now, they did rise dramatically with COVID, and they've come down a little bit, but still, if you are watching on the video, we've still got really significant deficits that we are expected to run throughout the rest of the 2020s. That's a really concerning thing when you already consider we've got $31.5 trillion of national debt. And then obviously, if we owe all of this money, some of it to China, some of it to other countries, and we are paying interest on that debt, that interest that we're paying is going to continue to grow with the more money that we owe on that debt, and that's going to become a bigger part of our national budget. It's going to be a bigger part of our expenditures. And so when I look at all five of the things that we've got going on here, we don't have enough workers paying into payroll taxes. We have too many retirees retiring every day. From $10,000 a day could go up to $12,000 a day. We have a growing percentage of our budget going to mandatory obligations, which means our politicians don't have as much fund money in discretionary spending as they would like. Our Social Security and Medicare trust funds, which are currently helping to pay recipients of those programs, those are running out within the next 5 to 10 years, depending on which study that we want to go off of. And then we also have rapidly increasing national debt, deficits, and interest payments. And so my question to you, this is not a rhetorical question. What do you think happens next in terms of our taxes? Do you think taxes are going to go down from the point that we're at right now? Do you think taxes are going to stay the same? Or do you think taxes will increase? I have no idea. I unfortunately broke my crystal ball, so it's not available. My guess, if you made me guess, is I would say that taxes will increase at some point in the future, and maybe the near future. Now, if you agree with me, and honestly, even if you don't, what we need to do for our taxes is we need to put a plan together to address what I think might be your biggest lifetime expense. And the only thing that might be higher in terms of what you've paid towards in your entire life is your house. With the mortgage, the repairs, the maintenance, maybe that's your biggest lifetime expense, but taxes might be your second. And in some cases, your taxes actually might be number one. But despite this being one of our biggest expenses of our life, too many people do not have a plan to lower this massive expense. And so I've got 9 ideas here that I want to share with you. And I want you to think of this as a buffet. You go to a buffet, and let's assume it's a really nice one. One of the nice ones in Vegas, maybe on the Strip, you're paying $50 a seat. And you've got a plethora of really nice options. You don't have to take every single one. And honestly, not every single one's going to be applicable to you and your family. So I'm presenting 9 options. Yes, there might be more, but look through this list and see what might apply to you. And obviously, if it's if it's something you don't really love doing and you're not sure of all the tax rules, you should definitely get some professional help. Make sure you just make smart, tax savvy decisions with everything that you have. So Again, 9 ideas, some will apply, some will not. The first thing, we talked about this in our last video, we've got to look at your asset location. In one of those examples that I mentioned, you could pay 15% on long-term capital gains rate in your taxable accounts. Well, that's a 15% rate. That's pretty good. If you put the wrong investment in that account, you might actually have to pay 22% on the dividends and distributions that you pay there. So the difference between 15% and 22%, that's pretty significant. So using asset location in a wise way, that can definitely lower your liability over the long term. The second thing that you might be able to do is to be really cautious about taking Social Security while you have earned income, because if you do that, a higher percentage of your benefit will be taxed, and they might actually deduct some of your benefits because of something called the earnings test, which you should look up. And yes, you do get those benefits back in many years from then, but it's gonna cut into your tax situation for sure if you have too much income while you're taking Social Security. Another thing that you need to think about in terms of your taxes is what's the most tax efficient distribution strategy from your investment accounts that is in line with your current income and your future income, with your current and future tax situation, with your current and future goals, etc. And so you have various sources that you can create this income in retirement and create that retirement paycheck we talked about before. Do you want to take money first out of your taxable investments? Do you want to spend down any extra you have in your emergency fund? Do you want to take money from your tax deferred accounts? Or do you want to take money from your tax-free accounts like your Roth IRA and your HSA? I cannot give blanket one size fits all advice in terms of investment distributions that are tax efficient on a podcast, on a video like we're doing right here. I've recommended different strategies for different people because, again, of their income and their tax situation and what their future tax situation is going to be. But I do know that you have to make a tax efficient, tax smart distribution strategy, and that can really help benefit you. Our next option that you have is something called a Roth conversion. I talk about this in my book. You can essentially take tax deferred money and move it into tax-free type accounts. You do have to pay taxes when you make that move, and it is not suitable for everyone, but it is a strategy that you should definitely look into. Another thing that you can do is you can contribute to a Roth IRA before you retire, so long as you are under the earning limit that is available there. Another option is you can contribute to a Roth 401k at work if it's available to you before you retire. Our seventh thing that you can do is you can engage in tax loss or tax gain harvesting, i.e. selling certain investments in taxable accounts that are either at a loss or a gain, and you do that strategically to take advantage of either the tax loss or the tax gain and the capital gains rate that you're paying at that time. The eighth thing that you can do, if it makes sense to you, is contribute to an HSA, a health savings account. Those are not right for everyone, so you definitely got to look into the details and see if that is suitable for you. The ninth thing that you can do is look into charitable gifts. You can either batch them together to increase your itemized deductions when you file your taxes, or you can use your QCD, which is your qualified charitable distribution, and you can use that to give to charities that way. So those are 9 different things that you can do. Again, not all of them are going to fit to your specific circumstance, but you should be looking at each of these options, seeing what makes sense for you, and making sure that you're doing everything possible in each of these categories so that you're not paying some kind of unnecessary tax bill. And so our recap for this episode is that taxes might rise in the future. The question I have for you is, do you want to plan for it or do you not want to plan for it? Boy, I really hope you say you're going to plan for it. The next thing, I've said this before, but you got to think of tax planning as a buffet. Not every menu item is going to be right for you, so just pick and choose wisely in terms of what's best for your situation. And then also these options, these tax planning options will change. It's imperative for you to know what's changed in terms of legislation and tax rates and tax codes on a yearly basis, because really, and I went back to Reagan, President Reagan, every president since then has changed the tax code, and Biden hasn't made any overhauls yet, any big overhauls yet, but he's going to try to And that's just something for us to be aware of. Every time we get a new Congress, a new president, we've got to be looking at what tax rates have changed. So I hope you enjoyed this video. I will see you in the next one.